Maybe a short introduction from my side, my background, my current employer. I've been in the, let's say, fundamental investing, team for close to 20 years. Before joining DECALIA in September, I was CIO at the Grove Petercam Asset Management, and I have been involved in, let's say, thematic ESG investing for more than 15 years. I was one of the, let's say, first to launch a dedicated ag and food fund. I will talk about it as well. I will not contradict the current speaker, the previous speaker, sorry. And so I joined DECALIA in September of last year. Why? Because DECALIA is a dedicated, very focused thematic asset management company, and has a very similar approach to where I was accustomed to, let's say, investing. And I will talk about it. And it's mostly related to, let's say, the value chain analysis, but also taking into account ESG, be it on the risk side or, let's say, opportunities, if you want, impact. I wanted to talk about the approach, the theoretical side, and then give some examples to be, let's say, to make it more visible. What is the approach we use, and I have been using for close to 20 years, and we have been using also for the thematic funds at DECALIA? It's a staged process where first we look at the subsector context, the sub-theme as such, and then we look at the bottom up. And I think it's a mistake a lot of fundamental investors do, is first go straight into stock picking and not have a clear idea of the subsector drivers, but also the challenges. And the challenges of a subsector, and the previous speaker has alluded to some challenges in the ag sector, are let's say, the starting point of identifying the challenges, but also identifying the companies that can tackle these challenges. That is the basic of impact investing in our view. And when we do that top-down sector analysis, what is crucial is identify the value chain. So from upstream to downstream, and ask yourself, based on that analysis of the drivers, the challenges, where do you want to invest in that particular part of the value chain, not only for fundamental reasons, but also for ESG assessment, both on risk and opportunities. And so that's a very targeted approach. If I would refer, for example, to the electric vehicle value chain, we are not going to invest or look at Tesla. We are going to look at which part in that value chain is more focused in innovation, has more pricing power, higher barriers to entry. And the innovation part is very important, but because ultimately the innovation will help you to tackle the challenges. And so as an investor, it's good to be aware of the challenges, but we always look at the glass half full. Equity investors are optimists by nature and try to find solutions to the challenges we have identified. And therefore, that value chain approach is crucial, and is becoming more and more important, taking into account regulation. If you talk about greenhouse gas emissions, Scope 3, or let's say social issues, the value chain approach is very important. And again, it's a balanced approach. We are not privileging performance or fundamentals against, let's say, ESG. We both think it's important. That's the difference between what we do and pure impact investing. What is crucial to understand, and what our mindset is in terms of looking at, let's say, and how we manage from a long-term perspective, is we identify the challenges and we see them as future opportunities. So we are looking at winners in that value chain to tackle the challenges. And we are going to identify, if you talk about impact, that part in the value chain with the most impact. That is really crucial, and again, it's mostly based on innovation. I will give you some examples afterwards. And what is also important, if you look at the value chain, and The food value chain is a good example. There are a lot of companies that adapt, try to use sustainable packaging or, let's say, taking into account their greenhouse footprint. But we are going to focus on enabling companies for change. And that is crucial, not only to outperform in the long term, but also to tackle the challenges that have been identified. So if you take, and I told you, I have been focusing on the ag-food value chain for a number of years. There are a lot of challenges, and these have been, let's say, talked about in the previous presentation. But what I think is really crucial in looking at all the challenges, there is a strong interlink between biodiversity and greenhouse emissions. That's often underestimated. This is the reason why we want to solidify the ecosystem, biodiversity, because it helps you to capture better the greenhouse emissions as a carbon sink or in the oceans. But also, if you have less deforestation, you have a more solid ecosystem. So there is a very strong interlink between the two. And as the previous presenter said, between 25 to 30% of greenhouse emissions come from the farm level, and certainly the biggest source of that is methane emissions. So the big issue there is the animal industry, where a lot of the methane emissions are causing the greenhouse, let's say, intensity. 50% coming from ruminants. But if you look at the value chain, and it's a pity we don't have that slide, if you go from upstream to downstream, you have approximately 90% of the greenhouse emissions that come from the upstream to, let's say, the companies that are close to the consumers, the Nestlé, the L'Oréal, and the likes. This is the reason as well that Nestlé has given a very, let's say, focused CMD on trying to tackle these challenges. But they are adapting, and they will have to, let's say, embrace enabling companies to tackle these challenges. And where we think the link in the value chain that will be crucial is indeed, and I'm happy I'm not contradicting Mr. Sieber, is food technology. So the ingredient companies will be crucial in attacking the challenges. Why? And where we focus very much on is fermentation know-how. So, and we are obviously looking at the listed space. We are of the opinion that if you look at direct greenhouse emissions or indirect, food waste and indirect greenhouse emission, fermentation will be crucial. What is fermentation? It's basically using microbacteria in a fermentation tank that is grown on carbon, on corn, on sugar, and producing all sorts of products, enzymes, cultures. You can have also bacteria to lengthen shelf life of products. But more and more, you're able to address that greenhouse issue that is prevalent in the industry. Why? Because a lot of the ingredients that are grown naturally, think of stevia, are transported all over the world and have an enormous greenhouse footprint, mostly coming from, let's say, scope 3. Whereas more and more companies, and there you have some very specific companies that are focused on that, are able, based on fermentation on algae, for example, to produce an equivalent stevia that obviously has not the same greenhouse footprint. And we are of the opinion that this is the opinion we have had already for a number of years, that these companies in food technology, very targeted, food technology companies with fermentation know-how, will be the winners in that, let's say, journey to tackle these very clear challenges. You see also more and more new end markets opening up for fermentation. Let's say companies with that specific know-how. For example, biodiversity, I told you in the beginning, is often underestimated. And a lot of people ask themselves, if you look at SDGs, SDG 14, life below water, how can you tackle this? Well, if you look, for example, at the salmon industry, or the fish farming industry in general, but also the pig industry, a lot of these animals are fed with fish oil. And fish oil is an oil that has been crushed because of the anchoveta that is being caught in Peru or in Chile. And so, again, a big issue, not only from a greenhouse gas footprint, but also you are destabilizing ecosystems, and obviously that has an indirect, if negative effect on your capacity to capture greenhouse gas emissions. Oceans are very important. What is now possible more and more, and a company like DSM is active in that, a company like Corbion is active in that, again, based on fermentation, produce an equivalent fish oil, and that is fed also from algae, to produce an equivalent, but to be able to replace a tremendous amount of the fish oil. So the project, for example, that DSM has with Evonik is able to replace, as we speak, it's a bit a higher price, 15% of the fish oil that is used in the salmon farming industry. So this is really crucial in our view, if you look at the value chain, where to position food technology companies will be the most impactful. And so this is the approach. So we don't make an assessment of the whole value chain and pick different spots. We really are targeted in the ones that will enable to tackle the challenges. Again, today's challenges are tomorrow's opportunities. This is an important, let's say, thought process. And obviously, as you can see from my explanation, this is a lot of qualitative analysis. We interact a lot with the managements of companies to really assess as well their ESG mindset, the innovation pipeline they have. We are not going to judge on the intentionality, which is the key starting point as well of impact investing. I think it's more important to assess the, let's say, the ESG mindset of a company, but that also, let's say, leads to a quantitative scoring. When we have identified that particular link in the value chain, we are going to compare companies between each other, take food tech, and look at the ESG risks, and that is a model we have, let's say, developed over the years, fed by MSCI data, but we are going to complement it, enrich it with our impact scoring. And that is often something that is, in our view, not done enough by the likes of MSCI and Sustainalytics. And we're going to focus very much on, let's say, a particular part in that impact, taking back the example of food technology. What is the fermentation IP of that company? How good is their process? What is their track record? What is the quality of the library of the IP? But also, what are the challenges they have in their pipeline to attack? For example, referring back to the example of DSM, everyone has heard of the, let's say, the methane pledge that has been agreed last year in Glasgow, lowering methane emissions by 30% by 2030. It was one of the few outcomes at that summit. That's obviously a big issue that needs to be tackled. There is one company as we speak that is commercializing a feed additive for cows that has been, let's say, tested, developed over the last 10 years that will enable a substantial lowering of the greenhouse gas emissions among cows. This is a company called DSM. So again, this is taking into account when we look at, let's say, the impact assessment. And it's a pity I cannot show the scoring, but DSM comes against IFF, Givaudan, Kerry, top-notch, best in class in terms of our impact scoring. Obviously, there are also ESG risks in terms of you have to take into consideration, because ultimately you need to look at the net positive impact. But this is, let's say, differentiating approach versus what you can see when you look at ratings or, let's say, impact assessments, because it's very, very targeted, based on, let's say, knowledge that has been, let's say, garnered over the last couple of years in a particular sub-industry. So I had also another example, but I think we can skip this. But I just want to conclude with the following. We are of the belief that, again, a smart and pragmatic way of looking at impact investing should be done through the value chain analysis. And I said it already in the beginning, this is also becoming more and more, let's say, value add, certainly when you consider regulation. We need to look at scope 3 emissions, footprint of the companies we invest in. So a value chain analysis comes in very handy. Same when you look at, let's say, social challenges, human rights, a value chain analysis taking into account, let's say, the upstream part to the downstream part, the risk related to that, the different actors in that value chain is really, let's say, important to enrich, let's say, the impact analysis for the companies considered. I will leave it there. I think we can follow, let's follow the presentation, and I propose we go to the, let's say, the panel. Thank you.
Thank you very much, Alexander.